Today, I'm going to show you the real practical math-based path to earning $1,000 a month in dividends. No hype, no fluff, just the numbers, the strategy, and the realistic expectations you need if you want dividend income to become a stable part of your financial life. Most people hear $1,000 a month in passive income, and immediately they picture some unrealistic fantasy. But once you understand dividend yields, portfolio construction, and how different investment strategies work, you'll see exactly what it takes and how achievable it really can be over time. Before we calculate anything, let me frame the goal clearly. Earning $1,000 a month in dividends means earning $12,000 per year. That's it. Everything else in this process depends on one factor: dividend yield. Dividend yield tells you what percentage of your investment a company or fund pays you each year, and this changes the entire equation. A 3% yield requires one level of investment. A 5% yield requires much less. A 1% yield requires far more. So, the real question is not, can I make $1,000 a month? The real question is, at what yield am I trying to earn it? If you've ever seen a stock yielding 10 or 12%, it's tempting to think, great, I only need a tiny amount invested. But that's exactly where inexperienced investors get burned. A high yield often appears because the stock price collapsed, not because the business is strong. In many cases, these companies are overpaying dividends they can't actually afford. And when the dividends get cut, so does your entire strategy. That's why responsible dividend investors typically aim for yields between 1% and 5%. This range balances income and sustainability. Now let's break down the numbers. If you want $12,000 a year in dividends, here's what you need. At a 3% yield, about $400,000. At a 1.5% yield, about $800,000. At a 0.5% yield, about $2.5 million. And yes, the last number is huge, but that's also why growth investors don't rely on dividends alone. More on that later. For now, let's start with the more realistic and commonly used benchmark: a 3% yield. At 3%, a portfolio of $400,000 generates roughly $1,000 per month in dividends. This is what you'd expect from a broad dividend ETF. Something diversified, stable, and made up of companies that have decades of consistent dividend payments behind them. A 3% average yield is rooted in reliability. These are the companies that have paid dividends through recessions, market dips, inflation cycles, and corporate disruptions. They're not the stocks that double overnight, but they also don't disappear overnight. This is the boring wealth strategy: slow, steady, predictable. And here's the part most people overlook. Many of these companies increase their dividends over time. That means your income grows even if you never add more money. It's like getting a raise every year without asking for one. Now let's talk about the opposite strategy. If you invest in companies that pay tiny dividends but grow fast, like many tech companies, you might only earn a 0.5% yield. And that yield, you'd need around $2.5 million invested to earn $1,000 a month purely in dividends. That sounds impossible for most people, but here's the interesting part. Because these companies grow so much faster, you might reach your financial goals sooner by selling small portions of your gains instead of relying on dividends. This approach isn't wrong. It's simply different. It focuses on total return, not just dividend checks. There's also a middle ground strategy that blends growth and dividends. If you invest in something resembling the total stock market, your yield might be around 1.5%. At that rate, you'd need around $800,000 invested. This is still a large number, but again, your portfolio value grows over time, and you benefit from both growth and income. Now let's get to the part most people get overly excited about: specialized high-yield sectors. These can get you $1,000 a month with significantly less money, but they come with very real risks. Let me break down the big ones. First is the energy sector stocks, 4 to 5% yields. Here you might only need $250,000 to $300,000 invested. But energy prices swing wildly and dividends can disappear during downturns. Second is REITs. These are real estate investment trusts with 4 to 6% yields. Here you need $200,000 to $300,000 invested. REITs are great income vehicles, but they depend heavily on interest rates and economic cycles. They pay well, but they're not invincible. Number 3 are high-yield individual stocks, 6 to 8% yields. These can require as little as $150,000 to $200,000 invested, but individual stocks are dangerous if you don't deeply understand the business. A dividend cut can ruin your entire plan. Many beginners chase these higher yields and end up learning expensive lessons. Here's something every dividend investor must understand. Dividend income means nothing if the dividend itself isn't sustainable. That's why experienced investors look at dividend payout ratios, free cash flow, earning stability, recession performance, and company debt levels. You want companies that can pay dividends in bad times, not just the good times. This is why Dividend Aristocrats, companies that have increased their dividends for at least 25 consecutive years, are so highly respected. They've proven themselves through economic disasters, financial crises, and unpredictable markets. They don't always offer the highest yields, but their reliability is the foundation of strong dividend portfolios. I know $400,000 might sound intimidating, but almost nobody builds this overnight. The realistic path is monthly investing, dollar cost averaging, over many years. Let me give you an example. If you invest $1,000 per month into dividend-focused funds and earn a 7% average return, you could reach $400,000 in about 18 to 20 years. If you increase contributions over time, you get there even faster. This is how real investors do it. Slow, steady, consistent. One of the biggest mistakes beginners make is spending dividends instead of reinvesting them during the accumulation phase. Reinvesting dividends means buying more shares, which then produce more dividends, which buy more shares. It's the snowball effect that accelerates your journey toward $1,000 a month. Even small dividends compound into something powerful over decades. Now let's talk about something nobody likes discussing: taxes. If your dividend portfolio is in a taxable account, you're going to owe taxes on those payments every year. This means $1,000 in monthly dividends might only leave you with $700 to $850 after tax, depending on your situation. To net $1,000, you might need to target $1,300 per month in gross dividends. Tax-advantaged accounts like IRAs and 401ks help dramatically because dividends grow tax-deferred, but you also can't freely withdraw them before retirement age without penalties. So this is a trade-off you need to understand clearly. Here's a perspective many dividend purists avoid. Focusing only on dividends can actually slow down wealth building. High-growth companies reinvest profits into expansion rather than paying dividends, which can lead to much faster long-term returns. In many cases, an investor focused on growth might reach $400,000 far sooner than a dividend-only investor reaches the same goal, even if that growth portfolio pays almost no dividends at all. Total return matters. But despite everything I just explained, there's something undeniably powerful about receiving real cash payments. Dividend income feels tangible. It feels earned. It keeps people motivated. And sometimes that psychological benefit is worth more than pure mathematical optimization. So here's the real answer to the question: how much do you need to invest to earn $1,000 a month in dividends? $400,000 at a sustainable 3% yield, $800,000 at a 1.5% yield, $2.5 million at a 0.5% yield, and as little as $150,000 to $300,000 in higher risk areas. The path is real, the math is real, and the only thing that decides whether you get there is when you choose to start. I'm Carlo. Thanks for tuning in. This isn't financial advice, but how you build your portfolio determines everything. It either grows into $1,000 a month in dividends or stays a number that never reaches its potential.